WAVE's future is aligned with low-footprint circular supply chains for the resources of the future. For over 21 years, we've been determining strategies, designing and engineering solutions, and delivering built assets for our clients. From a natural resource in the ground or a secondary byproduct to the advanced materials required to electrify our future, WAVE's expertise is being engaged globally. WAVE International, delivering commercially engineered projects for 21 years.
Hello, and thanks for joining me for a market update on technology and critical minerals. I'm Harry Fisher, a senior consultant at CRU based in Sydney. Today, I'll provide a brief overview of the latest outlook for the lithium and rare earth markets, key sectors for both Australia and within the technology and critical minerals space. But first, a quick introduction to CRU. For those of you who are less familiar with CRU, we are an international analysis, consulting and events business which is specialised in mining, metals and fertilisers throughout its 50-year history. We have offices in all of the major mining and end-use markets, allowing us to deliver detailed and independent advice to our clients from across the sector. We cover a large variety of commodities, including all of the key technology and critical minerals markets. So today I'll start with lithium. At the start of the COVID-19 pandemic, many expected electric vehicle sales to suffer in 2020 after a slow start to the year, with many major economies in lockdown. However, a green recovery has been the focus for many regions, which has provided a much needed boost to EVs. In Europe, 4 of the 5 biggest EV economies have new generous subsidy schemes. Western Europe will be the fastest growing market for EVs in 2020 by a large margin as a result of this, as shown on the left-hand chart. European sales of pure electric models in the first half of 2020 outstripped total sales in the whole of 2018. On the right chart, Chinese new energy vehicle sales had a slow start to the year as expected and have edged higher year on year but remain relatively weak. We expect that 2020 will be a second consecutive year without growth, despite some recent uptick from policy support. This slide shows our outlook for EV sales over the medium to long term. 3 factors are key in the pace of the EV transition: policy, affordability, and scale. Policy and subsidies have been important in recent years, but it's likely to only be a short-term factor, along with affordability, as EVs approach cost parity with internal combustion engines. Manufacturing scale will be the key factor. Without commitment to scale by the major car manufacturers, battery supply chains will not be able to build out to support the productions of tens of millions of EVs, as it shows on the left-hand side. OEMs will sell electric vehicles as fast as they can make them, but scale is really needed to support the rapid growth voiced by many in the market. For this reason, CRU expects EV uptake to begin to really accelerate from around the mid-2020s as OEM manufacturing capacity begins to ramp up. As shown by the yellow line on the right, the EV market share is expected to reach around 44% by 2030 and more than 60% by 2040. This has the potential to go even higher, depending on the degree to which various governments choose to enforce the phasing out of internal combustion engines over the next few years. So now to the supply side. Our analysis shows that there is sufficient lithium supply in the pipeline to satisfy our demand expectations of around 850,000 tonnes LCE by 2025. Even in a high demand scenario of say 1 million tonnes, there are still sufficient projects in the pipeline as shown in the top chart. In the bottom chart, around 80% of medium-term supply growth is expected to be from brownfield sources, whether that's increased capacity utilization, mine restarts, or further expansion phases. Price growth will be required, but the incentive price is much lower than that needed for new greenfield supply. As such, we expect prices to rise only to around $10 per kilogram LCE over the next couple of years, which is significantly below the price levels seen in 2017 and 2018, when new greenfield projects were coming online. Now for a summary of the rare earths outlook. We have recently updated our long-term forecasts at CRU for the rare earths market, and I'll share a couple of the aspects that are particularly interesting now. On the demand side, permanent magnets are the primary application of rare earth elements, as shown in the left-hand pie chart, along with many other small end-use markets. Magnets represent the major share of value on the right, at around 2.2 billion US dollars, despite only accounting for around a quarter of demand volumes. The main rare earth elements used in permanent magnets are neodymium and praseodymium. Neodymium magnets make up the majority of the market. High power magnets are primarily used in vehicles and wind turbines, accounting for around 57% combined of NdPr demand in 2019. We have modeled demand bottom up by researching motor designs and technology changes, rare earth intensities, and other end use considerations. All vehicles use this type of magnet for their motorized parts, such as windows and windscreen wipers. Electric vehicles, however, have a higher NdPr intensity than conventional vehicles, as permanent magnets are used in the drivetrain motors. This is a very important difference to internal combustion engines. Synchronous technology now accounts for around 95% of EV traction motors, and this has risen over the last few years, with only high-end models such as the Tesla Model S using AC induction technology for higher power and performance. The intensity of neodymium magnets in wind turbines depends on whether they are onshore or offshore. Offshore turbines use low-speed technology, which requires less maintenance and has a rare earth intensity that is more than 3 times that of the high-speed geared motors used in onshore turbines. However, neodymium magnet demand from wind turbines is expected to be predominantly from onshore turbines, despite their lower intensity, as the outlook for wind power generation is primarily from onshore capacity. Our long-term demand forecasts are based on the assumptions explained in the previous slide, along with the EV sales forecast presented earlier in the lithium section. CRU forecasts that the demand for neodymium magnets will be dominated by EV and consumer electronics in the medium term, as shown on the left-hand side. However, wind turbines will account for the largest share of total consumption over the long term. We forecast that wind turbines will become the largest use for neodymium magnets by around the mid-2030s, at which point it will account for around 40% of total demand. The second largest end use, EVs, will account for around 30%. This slow but steady growth in consumption from wind turbines is due to the long lifespans relative to other key end uses, and therefore the slow growth in replacement demand. As shown on the right-hand side, these two sectors will see the largest overall growth by a substantial margin, with demand from e-mobility increasing by more than 6 times and wind turbines by more than 10 times in volume terms from now to 2035. Now thinking more about rare earth supply and economics. We expect that China will continue to build out capacity, but the rate of expansion will not be able to match recent years due to environmental pressure and the capex requirements for new installations. From the 2030s, new investment will be required outside of China, most likely from the likes of Australia and the US. Prices today on a magnet basket basis are around $50 per kilogram. Our base case forecast shows that prices could increase substantially over the long term as the supply deficit widens from the late 2020s onwards. But due to the complexity of rare earth operations and the different production baskets for each asset, a typical cost curve such as this is not necessarily the best way to assess competitiveness. In this example, the Chinese producers in light blue are all towards the top of the cost curve. This is a 2025 cost curve for the major producers. But when the cost curve is instead ordered by the margin of each producer, based on CRU's rare earth prices, production costs, and the basket of each asset, many of the larger Chinese producers become more competitive. It's therefore important to consider both costs as well as margins for rare earth producers due to the variability in baskets between each asset. Margin curves help to get past the basket problem in rare earth analysis. So in conclusion, based on our analysis of margins, we're able to assess the average basket price required to incentivize new capacity investment. Based on this and the fact that NdPr makes up the majority of revenue for the major producers, we expect that prices have significant upside over the next few years. Thank you for listening. Please do not hesitate to get in touch if you have any questions or comments, and I hope you enjoy the rest of IMARC 2020.
Wave's future is aligned with low-footprint circular supply chains for the resources of the future. For over 21 years, we've been determining strategies, designing and engineering solutions, and delivering built assets for our clients. From a natural resource in the ground or a secondary byproduct, to the advanced materials required to electrify our future, Wave's expertise is being engaged globally. Wave International, delivering commercially engineered projects for 21 years.